Okay, we have a lot to cover. We're going to be covering before you buy a house in Texas, everything you need to know from start to finish. So welcome. Who is this video for? It's for a lot of people. It's going to cover those first-time home buyers. If you're relocating to Texas, you're going to be covered. New construction buyers, my self-employed buyers, and of course, buyers who are purchasing while they're owning another home. Now, a lot of times when people are looking to buy a house, they have to search the internet for many things. How to get started with the process. How much money do I need to put down? How do I pick a lender? So all of that information, I'm going to put it in this one video. So I don't want to waste time because we got a lot to cover. So what are you going to learn? We're going to learn the biggest mistakes that home buyers make. What are the real costs to buying a home? Understanding your monthly payment. That is very important. A lot of times home buyers buy and they don't even know what the mortgage payments are until they get to the closing table and they're shocked. Who actually works for you? Buyers, you actually employ a lot of people when you purchase a home, and we're going to cover that as well. Choosing the right lender. How do you go about doing that? Choosing the right mortgage company. How do you do that as well? There is a right way and there's a wrong way. Everybody wants to do mortgages, but are they the right people to do your mortgage? The interest rate game. How do people play the interest rate game? I'm going to talk about that as well. We're going to talk about self-employed buyers. Why is it so difficult for them to get home loans? And where can they go to get themselves a home loan if they're writing everything off? And then, of course, resale versus new construction, which is best? It depends. Then, how do you actually get approved? The house hunting process. When should you be looking for a home? The inspection process. The scariest part of the home buying process, there is a scary part. It's not often talked about, but I want to talk about that here. And then what builders don't always tell you if you're buying new construction, the biggest mistakes that home buyers make, and of course, what happens after the closing. And then if you stick around until the end, I have some bonuses for you. So please stay till the end. It's going to be really cool with what I'm going to give you as a bonus. So let's go ahead and get started. So what do most home buyers do wrong when they're first starting the home buying process? Well, let's say this. They always start with hunting for a home online. They're on Zillow, they're on HAR or Realtor.com. They see all these beautiful homes, they're happy, and they want to go out and look at these homes, but they're not pre-approved. So once they go out and they start looking at these homes, which I just took somebody out about a week ago, they were not pre-approved at all. And what ended up happening was they found a house that they really liked and they wanted to hurry up and submit an offer, but they could not because they didn't have a pre-approval letter. So now we have to get them with a lender that can get them pre-approved so that we can submit the offer. And they were worried and very concerned that somebody was going to come along and submit an offer ahead of them. So it did take 2 days before they got an actual pre-approval, and we were able to submit the offer, and they learned a very big lesson. Well, luckily for them, they were still able to secure the home with the pre-approval letter. So that's under contract now. So you do need to get that pre-approval. It's good for 90 days. Typically, it's good for 90 days. And after 90 days, they'll just, check your credit again to make sure everything is in good standing. But you need to have that pre-approval letter. Otherwise, the listing agent on the other side, they will not accept or even look at or even entertain your offer pretty much if you don't have that letter because they're going to figure that you're not being serious about it. The lender hasn't verified you, checked your income or any of those good things or your credit. And so they don't know if you can really be serious about purchasing their seller's home. So you got to have that pre-approval letter. The other thing is putting 20% down. Big, big myth. It would be nice to put 20% down because if you put down 20%, then you eliminate what is called PMI, which is private mortgage insurance. All it is for conventional loans, it's an insurance that guarantees that if the buyer should default on the loan, that the lender will be made whole. They'll get their money back. So when you pay your loan down within 20% of the appraised value, then they can eliminate that extra payment. It's not an extra payment, it's an insurance that you're paying. And depending on your credit score will determine whether that insurance payment is high or whether it's low. So if it's like say $140 or $150, then once you pay it within 20%, then guess what? Then that $100 or whatever that amount is, it goes away. But if you put 20% down from the very beginning, then you won't ever see that private mortgage insurance on there at all. So what do you put down then if you don't have 20%? Well, you have several options. You can do zero down if you're a veteran loan, USDA loan to zero down. If it's an FHA loan, you'll probably end up putting 3.5% down. If it's a conventional loan, it's typically 5% down. And then for those seasoned old school people, if you do something called a purchase money second or second lien, you put down either you do an 80-10-10 or an 80-15-5, meaning 80% first lien. You get a second lien for either 10% or 15%, and you only come up with 5% of your own money. Well, why would somebody want to do that? Well, they want to do it for a couple of reasons. Number one, you want to eliminate the PMI. You don't want to pay that private mortgage insurance. So that's one way to do it. And then two, you don't even have to escrow at that point if you're putting 20% down, because you can have more control over paying your taxes and insurance at the end of the year. You won't need to have the lender do that. And so if taxes go up or homeowners insurance go up, and then some people wonder, I get a lot of clients that come back and say, hey, my mortgage payment has increased and I thought it's not supposed to increase. It's locked for 30 years. Well, it is technically. If we're talking about principal and interest only, those two things never, ever, never, ever, never, ever change. But if we're talking about homeowners insurance with all the storms that we have in Texas, yes, there's a possibility that the insurance will go up. And then, of course, taxes, there's a possibility that taxes go up. So depending on what's in your escrow account, if it's not enough to cover the taxes, then one way for them to recoup that is to increase your mortgage payment until the escrow account gets back to an amount where at the end of the year they can cover taxes and they can cover the insurance. So how does a person prevent that from happening? Well, if you're very good at managing your money, then you don't escrow for your taxes and your insurance. I know a lot of people will say, why would she say that? Why do you want to get people in trouble with their mortgage? Well, you have more control over your mortgage that way, and you don't ever have to worry about the mortgage company increasing your payments because the insurance or the taxes went up. If it increases, you'll see it on your tax statement, and then now it's up to you to just pay that difference versus the mortgage company locking you in for, say, 6 months. Some people get locked in for a whole year, increase at $300 extra a month. They didn't budget for that, but you have no control when you're escrowing for the taxes and insurance. So just keep that in mind. So again, you don't have to put 20% down, depending on the type of loan you get. If it's FHA, it's 3.5%. If it's conventional, it's 5%. If it's a VA loan, it's zero down. If it's a USDA loan, it's zero down. But please keep in mind, and this is so, so important because I hear home buyers miss this one all the time. Even veterans, if you're putting zero down, yay, that's great. But guess what? You also have closing costs. So it's zero down. So you normally have down payment plus closing costs. So if it's zero down, meaning you don't put down the 3.5%, you don't put down the 5% for conventional, you put zero down for the veterans loan. All of those loans have closing costs. What are closing costs? Closing costs are going to be your say lender costs. The lender may charge an origination fee, an underwriting fee, a processing fee. So the lender is going to have fees. What about the title company? The title company has fees too. Oh, and back to that lender. There may be a charge for the survey, a charge for the appraisal, the charge for the credit report. Those are all lender fees. Then we're talking about the title company fees, where they have to file your deed in the courthouse. They have title commitment. They have these other fees that they have to charge as well. So you have those closing costs plus your down payment. And then a lot of times when people get down payment assistance, they go, oh, I'm getting down payment assistance. It's going to pay for my inspection. It's going to pay for my appraisal. No, 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 and no. We're going to talk about the next thing about those upfront out-of-pocket fees that you need to have when you do go under contract. So for now, just remember, whenever you go to get a loan, you do have to pay your down payment plus your closing costs. So the lender should be able to give you what your total closing costs are, meaning how much does it cost to complete this loan from start to finish. And when I get to the title company, which we're going to cover next, what's a title company? In Texas, we use title companies, whereas in other states, they may use attorneys. But for the sake of this video, we're using title companies. So what's my total out of pocket, come to closing, finish, get the keys to my house? They'll tell you that along with what your monthly payments are as well. Need to know what those monthly payments are before you even get under contract. You have to be very comfortable with the monthly payments. So your lender slash loan officer should be able to tell you total costs with the down payment plus closing costs, not just your down payment, because a lot of times they'll say, oh, and by the way, here's your down payment amount too. And then it's kind of like a shock to home buyers, but you need to know all of that. So the next section, we're going to talk about the real cost of buying a house. What are your upfront out-of-pocket costs? So let's kind of recap again, because we can get lost in the sauce with this. So we said that before we start looking, we're going to get a pre-approval letter. The pre-approval is going to tell us what our monthly payments are estimated at. They'll give you an amount. Maybe they'll approve you for a maximum amount. You can always buy less. So let's say they approved you for $500,000, but you really wanted to buy a $300,000 house. No problem. We can get the letter changed to $300,000. So let's just say $300,000. You know what your monthly payments are. You know what your closing costs are, which is down payment plus closing costs. But before we even get to that stage where you have the pre-approval letter, what do you need to have sitting in your bank account that you have to pay out of pocket before you get to the closing to pay those closing costs? Well, you need to have something called earnest money. And you need to have your option fee ready, and you need to have money for your home inspection. You also need to have money for that appraisal. So how does that work? So let's say we found a house. The house costs $500,000. We have the pre-approval letter. We're going to go ahead and submit the offer. So the contract is written up with the terms that we discussed that you want to submit for it. And along with that contract, we got 3 days to turn in the earnest money and option fee. Earnest money is like a form of down payment, separate from down payment for the type of loan you get. Has nothing to do with each other. That's another confusion that happens a lot with home buyers. They go, well, I already gave earnest money. Why are they asking for down payment? Has nothing to do with you submitting your offer with the pre-approval letter. So earnest money is typically, it's not written in stone. Anything I say here when I'm talking about contracts and money, it's not written in stone. It's negotiable. They had this big lawsuit here in Texas about all this. So just take what I say as everything's negotiable. So that's my disclaimer here. Everything is negotiable. Please remember that. So anyway, the earnest money is typically 1% of the sales price. Doesn't have to be. Investors, they do their thing, but when we're talking about in the resale or buying a home, a little bit different from new construction, but 1%. So if the house is 300,000, you'll need to have a check ready for $3,000. And the option fee, it varies. It may be $150. It could be $200. If someone else is submitting another offer and you want to beat that person out, then you may do an option fee of say $500. But do note that any money that you submit along with the offer, whatever your closing costs are, that money will be subtracted from that. If you decide that during the option period, which I'm going to explain in a minute, you no longer want the house after you got it inspected, then you will get your earnest money back, not the option fee. Reason being, and back to the option fee, like I said, the option fee may be $200, $300, $500. If you're not competing, maybe it's $150 for 7 days or $150 for 10 days, whatever you write up. It may be 5 days, 7 days, 10 days. The purpose is for you to pay the seller a little bit of money for them to take the house off the market so that you can have the home inspected. So for that $150 or whatever you paid, you now get a look at the house. You get to have it inspected. You get to see if this house is in pretty good shape for you to buy. So it's kind of like if you have inspections done and the inspection report comes back and there's something on it you don't like, it's like, whoa, this house has too many problems and I don't want to buy it. Well, because you had that 7-day or 10-day period, and you paid for the right to have the seller take it off the market for you to have it inspected, now you can change your mind. You would not get that option fee money back because that's just the cost of doing business. So at least it's a small cost relatively. If you think about, you could have spent $300 or been out of $300,000, but you only paid 150 to have it inspected to see, no, you really shouldn't be buying this house. So if you decide to buy the house, then of course that option fee money, whatever that fee is, will be deducted from part of your closing costs. So let's just recap that. The option fee and earnest money has nothing to do with the loan, which has to do with your down payment and closing costs. Even though when you get your total closing costs, the money you did submit, which was the earnest money and the option fee, that money will be deducted from your total overall costs that that the lender end up telling you what it is. So that money will be sitting at the title company in escrow. We're going to talk a little bit later about who's the title company, where do they come in at? Because you do have a team of people, and a lot of time home buyers confuse the real estate agent with the loan officer, the lender, and the title company. It can get very confusing, but I'm going to break all of those roles and jobs out for you as we go along. So for starters, before you even start the process, before you even get the pre-approval, do you have this money sitting in a separate bank account that you'll be using to purchase your new home? What is that money? Earnest money. Remember, about 1% of the sales price of the house. Whatever the sales price is, if it's 500,000, 5,000, 400,000, 4,000. Is that money sitting in an account? Because right away, you got 3 days to get that money over there. Some title companies have a software called Zocam or this other software, but again, you have to be careful and just confirm that that's the software. And if you can normally take a picture of the cashier's check that you get from your bank, and then through that software, it can get the money over there pretty quickly. So got to have that earnest money in the account. You got to have the option fee money somewhere in your bank account as well. So you could just roughly estimate about, say, $200, $250. Unless you're competing, it'll be a little bit more. Home inspections, as soon as you go on a contract. Remember, if it's a 7-day option, you got 7 days to get the home inspected. Most inspectors, they will inspect the home within 2 days or so. They can get out there and they will give you the inspection report in the same day. So you can get it back pretty quickly. If you see anything in there major, not cosmetic, sometimes people say, oh, the paint is chipped up. No, we're talking about plumbing. We're talking about electrical. We're talking about, do we need a new roof? Things of that nature. Major, major big stuff, or foundation issues, things like that. So, but you will work those things out with the seller if they're going to pay for stuff or they need to fix stuff. Some things, if the house is older, it's going to be normal wear and tear. It's not going to be up to standard or up to speed in terms of the code because of at the time it was built, yes, it was up to code, but if it's a home that was built in 2000 or 2005, expect that a lot of that stuff is going to be called in the inspection report because of coding. So upfront out-of-pocket costs, just to recap again, in the bank, have your earnest money ready because they're going to need to send it to the title company. Have your option fee money ready. Normally, you can put those two together. That'll be one amount. Then have your inspection money. Inspections, depending on the square footage of the house. If it's a big house, it can probably run you about $600 for an inspection. If it's about 2,000 square feet, something like that, maybe it'll run you 400, $500 for the inspection. But that money has to be paid to the inspector before they do the inspection or immediately after they finish. They won't release the report until after you pay them. So make sure you have that money ready. And then, of course, once we pass the option period, now the lender may go ahead and order the appraisal. So when they order the appraisal, it can run you about $700. It just depends if it's an FHA or conventional. And you need to have that money ready. They're going to want you to pay for the appraisal report. And then the survey, they can pay for that, and charge it to you at closing. That should be calculated in the estimated closing costs that the lender will give you when they give you your total down payment plus closing costs. And sometimes for homeowners insurance, and this is very important. You don't have to have this, but when they tell you to find out who you're going to use for your homeowners insurance, a lot of times people do that bundle with their car, and the agent would try to say, oh, you can pay the first year up front now, or you can pay half a year. Tell them you just want to get this information over to the lender. You can pay that at closing because the lender has already factored and calculated that in so that you can pay that at closing. A lot of times, for some reason, I don't know why these agents try to get the buyer to pay it up front. You don't have to pay it out of pocket and up front now. Just remind them, look, I'm going to be paying it at closing, and you can definitely pay it at closing because the lender will need the declaration page. They're just going to give um, um, they're going to give the lender needs to have on there the homeowner's insurance, the loan number, and the mortgagee clause, like whoever's going to be the lien holder. They're going to have their information on there. So just make sure you let them know you're going to be paying that at the end. And the other problem with homeowners insurance is that it can hold up a closing. I've had the lender call me and say, "Hey, we're clear to close, and I mean we want to close. We want to issue the clear to close, and clear to close is another whole issue. We're going to talk about that too. We want to close, but your buyers have not turned in their homeowners insurance." It's like, but from the beginning, so anyway, in the beginning, shop for the homeowner's insurance. Get that turned in right away because it's one of those things that you go, oh yeah, I'll get it. And then when it's time for us to go and close, you forget all about it. So it can hold up a closing. So don't let that be you where you don't get that homeowner's insurance turned in time. Okay, so moving right along, flood insurance. If you're not in the flood zone, if you're in Texas, you're not flooded today, but next storm you may be in the flood zone. So it's up to you to get it. It's real inexpensive when you don't have it and don't need it. So it's like a catch-22. It's best to be caught with it than to be caught without it. So that takes care of that. We talked about the down payment. All right, gift funds, you can do gifts. So closing costs covered all of that. It could be, like I say, the loan, title fees, escrow fees, recording, prepaids, all of that good stuff. It's gonna have all of those good things in there. And they're gonna tell you what you're gonna need to close. So the other thing is I forgot to say on that is the homeowners insurance. Oh no, homeowners association fees. When you buy a house at the end of the year, they have these things called HOA dues. What are HOA dues? Well, when you go into a community and see how pretty it is, and you see the flowers and the crepe myrtles, and the community is nice and clean and all of that good stuff, well, those are the HOA dues. So it could be $500 a year, it could be $1,000 a year, whatever that price is. It's that price that the homeowners individually pay when they keep the community beautified, they keep it pretty, they keep the grass trimmed and cut and watered and all of that good stuff. Anyway, and they have rules too, the do's and do nots, things that you can and things that you can't do. So you got to be very careful with that as well. But the lender uses that number, I don't know why, but they do, to calculate your mortgage payment. So if your HOA dues are, say, $1,000 a year, they're going to divide that by 12 and take that monthly amount and include it in your monthly payment. But at the end of the year, when they're busy paying your taxes and paying your insurance in one swoop, they don't pay your HOA fees. They should. You would think they should, since they use it to calculate what your mortgage payment is. So don't forget to pay it, is all I'm trying to say. If your HOA dues are $1,000, just know at the end of every year, you got to go and pay them $1,000. Yes, you got to go and pay them, whatever that is at the end of the year. One swoop, you pay them. The lender is not going to pay it. And a lot of buyers forget to pay the HOA. They say, well, they calculated in my mortgage payment. Yes, they did. But they forgot to tell you that they're not responsible for paying your HOA dues. You are at the end of every year. So just remember that. Now, there's a mortgage calculator that I like to tell my people about. You go to a website called bankrate.com, and they have a mortgage calculator, and you can play with if you put extra payment on. In addition to your regular mortgage payment, if you put an extra payment in there, then it will quickly reduce the amount of years it would take you to pay it back. So let's do this perfect example. On bankrate.com, if you pay an extra, say $200 a month, and lenders don't want you to know this. They always say, oh, you can make an extra payment to a year. What if you want to make an extra 10 payments a year? The more payments you make extra, it eats into the interest that you have to pay them. So perfect example. And I did this example on TikTok, and believe it or not, they had about 14 or 15,000 people look at this one video. I said, I need to do one for YouTube because I didn't know it was that popular and that hot. So if you borrow 300,000, you're going to be paying back something like 300,000. So that's like $600,000 for a $300,000 home. So $300,000 in interest. So how do you get back a chunk of that money and interest that you're paying to the bank? Because for the first 15 years, you have to remember that you're paying interest up front for the first 15 years before you even barely scratch the surface on any of that principal. But there's a way that you can tap into that and reduce that 300,000 in interest that you would pay back and get it down to say 200 or maybe 150,000, or maybe they only get 70,000. Can you do that? Yes, you can. And how do you do it? By paying extra on principal, because you'll see it right away. So if you get your mortgage statement and it shows that you had a balance of say 200 and let's say 50,000 for argument's sake, and you sent in an extra $100. That next mortgage statement, now instead of saying 250,000, you'll see 200 and say 250, 200 and 200 240,000 is what you'll see because it reduced it by $100. Let me do my calculator. I'm not pretty good with my numbers in my head like that all the time, but this you understand what I'm trying to say. So if before, like I said, you had 250,000 and you put 100 down, now you got $249,000. Yeah, you'll see it right away. It's actually 249.9. I don't know why it's 249.9, but it's 249. I think I left a number on it. Hold on. 250 minus, and I said 100. 249.9. You'll see that right away. Then if you do another 100, you'll see 249,800. Okay, I see what was happening now. Okay, I see where I went wrong. But yeah, so you'll see it right away. But if you waiting to just make your regular monthly payments like you're doing, it's gonna take forever for that number to go down. But to see immediate, if you put $1,000 on there, you'll see that reduction right away. So I was at 249,800 from 200 minus 1,000. Now you'll see instead of 249, now it's 248.8. That with that $1,000 reduction. So as you keep sending money in towards principal, it's going to reduce it just like immediately because you're doing it for principal. But this is the catch with that. Some mortgage companies want you to send it into a different location. So don't just say, okay, with my mortgage payment, if your mortgage payment is, let's say it's $3,000, and you say you want to pay an extra 100, don't send in 3,100. If you send in $3,100, guess what's going to happen? They're going to take that extra $100 and subtract it from the principal. Yeah, they're not going to do it for your principal payment. You have to literally tell them where you want that extra money to go. Because if you don't, it's going to be going to reduce principal. Who wants to send in extra money to reduce principal? No, you want to reduce what am I talking about? It's going to go towards interest. It's late night. It's going to go towards reducing interest, people. I'm sorry. So if you send in that money, you don't want them to reduce interest or be paying towards interest. You want it to go to reduce your principal. That's what I'm trying to say. It can get confusing. See, even I get confused and I know this stuff. So to recap again, if you want to pay extra on principal, you want to call the mortgage company and say, hey, how do I pay extra on principal? Where do I send it? Or do I send it to the same place I send my regular mortgage payment? And they will tell you why. Sometimes they want you to send it to a separate location. I don't know. Maybe they get confused themselves like I just did. But just remember, you can affect the principal and you can affect that interest that you're paying to the mortgage company immediately. The other thing with affecting it immediately, it also reduces the amount of time you have to pay back. If it's 30 years, now it becomes 25 years. It can be down to 17 years, 15 years. The more you pay on principal, the faster. If you play with those calculators I told you about on bankrate.com, you'll see how quickly and how fast you can eat up the interest that you'll be paying back to the bank. And they don't want you to know that. That's why I tell people, I don't care what your interest rate is. They go, oh, I want to get the lowest rate. Yes, it's good if you have a big loan amount and you want to pay the least amount. You can also do that if you take control over your escrow account. But the fact of the matter is, whether you get small interest or big interest, um, whether you get small interest or the big interest, you want to eat up as much of that interest that you're paying back to the bank as possible. Okay, and I know I'm gonna get a lot of fights on this in the comments too. A lot of people say, well, you can take that money and if you got a low interest rate, you can invest the rest. And that's all fine and dandy. I'm not saying there's nothing wrong with that. Sometimes people want to get a very low interest rate because they can get a higher rate of return on their money without paying their mortgage off faster. And I'll tell you a story. So I know several people that have paid their homes off and for whatever reason fell on hard times. Their businesses weren't doing that well, but they were so happy and so glad that they had their mortgages paid off, because if they didn't have the mortgage paid off, then they would have been paying almost $4,000 a month in the mortgage payment, which they didn't have the money to pay. They lost their jobs. They didn't have some people didn't have the jobs. Some people didn't have their businesses anymore. And by not having that big chunk of mortgage to pay, it helped them. Whereas you get those that's doing very well, they have money, they're very successful. Yes, they can take and invest that money, but the negative part of having a house paid off is if your credit is bad, now you can't go and tap into your own equity to get your own money out because you have bad credit. That's kind of like a downside. It's kind of up, but it's down. It depends on your situation. So with all of that being said, let's kind of move on because I'm getting in the weeds here. So again, remember bankrate.com for that mortgage calculator. Play with that. Even if you want to play with it just so you can get that PMI off of there, that private mortgage insurance removed, that's a great way to go ahead and do it. And remember about paying extra on principal. Find out from the lender, do you send it to a different place? And also, when it comes to the interest rate, as long as you're paying extra on principal, your goal is to eat up as much interest that you're going to be paying back to the bank as possible, unless you got one of those low interest rates where it's like 4% or 3%, then, you can afford to make those mortgage payment. Now, who actually works for you? Wow, this is a good one. So buyers, when you're buying a home, guess who you employ? You employ real estate agents, you employ lenders, you employ the appraisers, you employ inspectors, you employ the appraisers, you employ you have transaction coordinators, you have all of these people that are working, believe it or not, and people at the title company. All of those people have a role to play in helping you get your new home. All of those people are involved in this whole process. And even as a buyer for your team, you want on your team, you got a real estate agent, you got your loan officer, you have a transaction coordinator. Those are people that's going to be keeping you abreast of everything. Because even though the title company is part of it, they're separate and they're in the end. The title company is in the very end. The realtor is in the beginning with the lender, because the lender and the realtor are two separate people. Sometimes buyers think they're the same. They're in one. No, they have two separate roles. The real estate agent is strictly dealing with the property. That's it. They don't deal anything with finances, your credit report, bank statements, and all. They have nothing to do with that. But even though I was a mortgage broker, I understand how that side works, so I'm able to keep my buyers calm when something happens on that side and move their loan if we need to in case something happens on that side, but that's another story. So the real estate agent deals strictly with the property, getting amendments, if they need more time, getting extensions and stuff like that, with the inspections, working out, negotiating on that part. The lender doesn't negotiate anything to do with the property. They don't have anything to do with amendments. They work on the financing piece. They work on your verification of employment. They work on getting your tax returns and all of that good stuff, or marriage certificate, whatever. They work on getting all of those good things in according to what the underwriter states that they need. So let's talk about that for a minute. I may talk about it before, but I want to bring it up now. So when we're talking about the lender and the getting those documentation and all of that stuff in. Again, this is the part where I say get the homeowner's insurance in time. The underwriter speaks to no one. The underwriter is almost like a silent person, but they're involved. They're going to be the main people that issues you the clear to close. And you're probably going, well, what's a clear to close? Well, the clear to close is, to me, is the most important part of this entire transaction. It's silent, but nobody really talks about it. They talk around it, they talk through it, they talk on the left, they talk on the right, or the left, and they talk on the right. But it's the most important part of the transaction, if you ask me. Not the pre-approval, not the conditional loan approval, but the clear to close. And I believe I go into more detail a little bit further down. But that's the most important part of this whole process. But the underwriter, you don't get their phone number. They work on behalf of the lender. They be making decisions. They be making people mad. So let's just say that. They be making people so mad because they won't release the clear to close, and people want to go and beat them up. I'm just going to say that. But you don't get access to the underwriter. You don't even get to email them or tell them off or yell at them or call them up and call them names. You only get to do all that to the loan officer, unfortunately, the lender, the loan officer take all the hit and all the grief that the underwriter should be taking, because when they can't get your file out of underwriting, because the underwriter is like, who is this underwriting person? You want to put a name to the underwriter, but you really can't put a name to them, but they're holding up the whole loan file. And the poor old poor loan officer, getting text messages, getting threats, getting phone calls, scared to answer their phone, scared to even respond back to a text message, to even say, I'm at the mercy of the underwriter. I don't know when they're going to release your file. I don't know what's going on with it. They won't tell me anything, but they're saying, you're lying, you're lying. You know what's happening. You know what's going on. Tell me what's going on. When am I closing? So now people are all upset. They're all stressed up out. They're all fighting and stuff. That's why I'm going to show you the bonus at the end why you won't be that person that's doing that. But it's so much going on. And so you'll never talk to the underwriter. And then if they come out and say they're not giving you the loan, then that's it. That's it. You will not get the loan. You ain't closing, and you done spent money on inspections, you got an appraisal done. The survey is probably ordered at this point. You've given up earnest money, and you passed that point where to say you changed your mind to get your earnest, you're gonna lose all of it. You're gonna lose everything. And there's ways to make sure that you're not a victim of the underwriter, because when they request something and you don't get it in, or something should happen, then things can go south pretty quick. So we're gonna make sure you're not falling into that category, and make sure you have a smooth closing that I can get you, I'll say 99.9% there for a successful closing if you follow the instructions and the rules and stuff that I'm giving you in this video. You're gonna be ahead of the game. So anyway, just remember that the real estate agent and the loan officer / lender, two separate people, two separate jobs. Then you have your transaction coordinator that works with the lender. They work with they work with the lender. I shouldn't say, well, actually, the lender has a processor, not the transaction coordinator. I'm sorry, let me take that back. The transaction coordinator is working with the real estate agent. So the transaction coordinator works with the real estate agent to communicate to the lender, to communicate with the title company what's going on with your file. So we got real estate agent, lender, transaction coordinator, title company. Title company, they don't get to hear nothing or know nothing. They're just waiting for however many days within the contract to be up. So let's say you're supposed to close in 30 days. So in 30 days, now the title company comes into play. They go, hey, where are my docs? Waiting to close my peeps. It's been 30 days. Are we going to get any loan docs? So the lender is going to send the loan docs to the title company so they can prepare them for you to go in and sign as the buyer. Whereas the real estate agent is communicating with not only the listing agent on the other side, communicating with the title company and the transaction coordinator to make sure everything is looking good. If there's any amendments to be done, then the real estate agent is going to send it over to the other side. Hey, sign, we need an extension, or hey, when we got the inspection done, sign, we want the seller to fix these things. So the realtor is just in the middle. Me, I just try to make friends with the listing agent to keep them abreast of everything. Don't keep them in the dark of anything in case something do come up. At least they know that we've been forthcoming. We've been communicating with them this whole time. So if we do need to get an extension of some sort, then they will be willing to give us that extension once they talk to the seller. Because it's really up to the seller whether or not they want to give an extension and not the listing agent. But you want to just kind of make sure that they are kept abreast of everything. So we've already beat that horse to death about who does what. Now, when we talk about the excuse me, the appraiser, the appraiser is going to appraise the property. So sometimes people go, well, I don't want to pay more than what I'm supposed to pay for the house. Well, that's not possible. Just had an incident where the appraised value came back $16,000 less. Now, the sellers weren't happy about that. However, it's very hard for a lender to call an appraiser to have them change their mind about what they appraised the property at because they're not supposed to be communicate. They don't communicate with the appraiser. They just send a third party out to do an appraisal, and the appraisal comes back either at value or not at value. Well, what happens when it comes under value? Well, there's a couple of things that can happen, so be aware of this. Number one, if the property was supposed to be for 400,000 and the appraised value came back at say 380,000, there are three things that can happen in this scenario. Number one, the seller can say, okay, all right, I'm going to reduce the price to 380,000 because your lender sent an appraiser out and the appraiser said my property is only worth 380,000. Number two, the seller can say, my property is worth $400,000 and I'd be darned if I'm going to be reducing my property to 380,000. They better pay me my full $400,000. And of course, the lender is going to say, we're not going to give you a loan greater than 380 because that's all it said that the property was worth. If you want to pay that extra $20,000 out of your own pocket, then you feel free to do that. We don't care. You can do it. And then that's what you do. Or they can say, well, let's split the difference. Instead of 20,000, how about you spend 10,000, so you pay 390, and then the seller will eat the cost of the other 10,000. So those are the three outcomes. Don't expect that the seller is going to automatically, willy-nilly, just throw their hands in the air and say, we're going to reduce it by $20,000 because there's a strong possibility that they will not do that. So be prepared for that to happen. Okay. So just wanted you to know that because it actually happened and we had to go back and forth and it wasn't pretty because the sellers felt very hurt. They felt bad. They had done a lot of upgrades and they really felt that their property was worth, the money that they had listed it for, and they didn't get the value that they had expected. So they weren't happy at all. So choosing the right mortgage, that's the next thing I want to talk about. Oh, choosing the right mortgage. How do you do that? There are a lot of lenders that are out of state. Texas, for those of you who don't know, we're our own country. Yeah, we do things a little bit differently. One thing that we do very well is we have a whole Texas Real Estate Commission, and most states try to mimic and follow us because we have our stuff together when it comes to contracts. I'm just going to say that. And other states, they don't have as detailed and contracts as we have when it comes to protecting our buyers and our sellers. But on the flip side of that, there are a lot of lenders that try to do Texas loans. And I'm not trying to bash on those lenders and things like that, but a lot of times they're in different time zones, they're in a totally different state. They don't know how we do business here. And when we're open, they're not open. When we're closed, it can just be a whole mess when it's a lender that's in a different state. I'm not saying that it hasn't been done. I've closed with lenders before. I just know that sometimes complications, can happen and does happen. The other thing is they don't know how things are done in Texas. That's just all I'm going to say about that. The other thing is you have your banks versus your mortgage brokers. Well, what's the difference? You got credit unions too. Well, I would just say this. Mortgage brokers, I used to be a mortgage broker, so I'm kind of biased. Hmm. We have access to a whole lot of different lenders, not just one. When you work for like a big bank, I won't name any big banks, they're just like a one-trick pony. It's their product only, period, end of story. That's all they have. That's all they can show you. If you don't fit in the square peg perfectly, then that's it. That's all they got, right? Whereas a mortgage broker, they have access to unlimited lenders that they can send you to. If you don't fit in the square peg, no problem. They move you over to no problem. And that's what they do 24/7. It's like going to get like a root canal. You get one from either the dentist or you get one from an endodontist, a specialist, a person that's all they do all day long is they just pull or do root canals. So it's your call, it's your choice. Now, sometimes the big banks charge more. I used to work for a big bank before I was a mortgage broker. And let me tell you, not only was I fighting with the underwriter all the time, my files would literally get stuck in the pipeline. And my buyers would be calling me, they would be crying, I'm crying, and I can't get an answer out of the underwriter because I don't know if they chewing gum or eating cookies or donuts or pies or whatever, but they're not answering the phones, they're not returning emails. All my buyers are at my office, they're not closing, and they're saying that the problem is on uh the exterior when the problem is on the interior, because then if the rate lock expires with their interest rate, then they charge it to the loan. It was just a big old ugly mess. I didn't like it at all. It was just horrible. And that's why I became a mortgage broker, because I couldn't service my clients the way I wanted to service them. Because not only did they not fit in the square peg, then when they finally came out to give the loan approval or not, or the clear to close, they didn't approve them. And then now my buyers that moved out or are supposed to be out of their place or living in a hotel, it was terrible. It was terrible. So now, when you're with a mortgage broker, they're going to do whatever is possible to get that file closed or to get you a loan product, because they're not a one-trick pony. They have several different options, and not all lenders are the same. Let me just put that out there too. I've had it where I've had to pick up a loan file with permission from the buyer and send it to a totally different lender, and that lender couldn't get it done. Send it to another, and let's talk about this. It was for truck driver. Truck drivers, the way they get paid is totally different from other people, and the way their income is calculated. And not all lenders will calculate their income the same, because this particular truck driver, I think I must have sent them to 5 different lenders. And because their home was being built, we had time to do this. But I sent them to 5 different lenders. And finally, on the fifth one, they were able to calculate the income, get them approved, and they had a loan. So don't give up just because they say that they can't do your loan. Just because that lender can't do it. They'll say, oh, if I can't do the loan, no other lender can do it. Hockey pock and bull hockey pock. They can do it. So you just have to be willing to just let someone else take a look at it. That's why before you even get a loan, shop in the beginning. If they say they're going to pull your credit and you're concerned about that, at least if you get 3 different lenders to look at your file, you'll see what the fees are. It's going to be the same credit pulled. It's not going to hit it every time they pull it, because for the first week or two, they know you're shopping for a loan. So therefore, they're not going to keep allowing the score to go down. So while you're shopping, just get 3 different lenders, and also know that I'm going to talk about the interest rates in a minute here, but just shop and get. They can't lock you in. Some lenders will say, oh, we'll lock, this is your interest rate. The rate you see when you're shopping is not going to be the rate that you get most of the time, because if you don't have a property, they can't lock anything in. They can't lock in a fictitious or to be determined property. You can't just make up an address and put it in there and lock it. So if the rate is good when they give you the pre-approval, now it's time for you to actually, you submitted an offer and you got a contract. Oh, the rates could have changed, because rates change every day. So just know that the rate will look good when you get the pre-approval, but it may not be the same by the time you get ready to lock. So just know that. So those are the advantages and disadvantages of having mortgage brokers versus credit unions versus big banks. Big banks can make you want to choke out somebody and be mad at a lot of people. So just be very careful who you select as a lender. kind of ask around. I mean, it's really up to you to select whomever you want. You're not obligated to any one person, but there's a huge difference between the big banks versus the mortgage brokers and even the credit unions, even the fees. Look at the fees. The APR will tell it all because that's the cost of doing a loan. When you look at the fees on those, that'll tell you everything that you need to know. Here it is. Perfect. Perfect timing. The interest rate game. See it on the news or see it on TV all the time. Oh, come in, get this low rate. First of all, those interest rate, if you look under the TV advertisements, got in fine print. When you see that low rate, either that person put down 20% or they're getting a 15 year mortgage, or they have really beautiful credit scores. That's what they say. But it's a variable. It differs for each person that comes in. It's not guaranteed you're going to get that loan. So somebody with barely good credit, someone that's only putting down a very small amount of money, you're not going to get that perfect rate that they're talking about because there's too many variables. So when you see it, it's just a trick to get you to come in. If you've been paying on your loan for 10 years and you want to go and refinance and get that little loan, unless it's like a percentage point difference or even a little higher, it's probably not even worth it to do it because now you're going to um, amortize that loan, and then you're going to start from the very beginning to paying very little principal and a whole bunch of interest to the lender, and so you need to look out and watch out for those things as well. So just be careful about, like I said, the interest rate. The whole point is if you get a low rate, great. Your goal is to pay as much on principal as you can. You'll be building equity a lot faster, I should say. And just be careful. Then, of course, sometimes they'll bring you in and say, hey, if you keep bugging me and telling me about an interest rate, I want a low interest rate. So and so gave me a low, no problem. They're at 6.5%. You want 5.5%? I get you 5.5. To go, really? Yes. But guess what? I'm gonna charge you some discount points. So you're so focused on that interest rate that the discount point is a fee they charge you that you're going to pay the rate down to get to that 5.5. That discount point may have cost you $10,000, but you just don't care. You just want the interest rate low. So you rather pay 10 grand to get it low. Or if you can't get it at from 6.5 to 5, maybe you want it at 6%, or maybe you want it at 5.75%, but they could just charge you some discount points to get the rate down. Just got to be looking at that. So when you keep hollering and hollering, you want lower, and they give you a 0.25% difference better, it's probably they charge you a discount point. So look at that. You'll see that too. And we already talked about the types of loans: conventional, FHA, VA, USDA, jumbo, or something called a non-conventional loan. With those are the loans that are high dollar loans. And then we got these new construction loans. Now, I want to talk a little bit real quick about the difference between new construction loans and resale loans. Or not resale, when you go to buy a new construction home versus buying a resale home. New construction is a little bit different from how I told you in the beginning. You got to have your earnest money, your option fee, those types of things. So for the new construction, loan, give me a second. I have to close something up real quick. Getting dark outside. I want to close that up. Okay. So new construction is a little bit different from purchasing resale. So new construction, you do a true down payment. Excuse me, for new construction. So they may say you need to put down $5,000 or $2,000. You don't put down earnest money and option fee for new construction. You just put down a down payment. And then when it get close to you doing your first walkthrough, you can do your inspection before you have your first walkthrough for new construction. Whereas resale is exactly how I told you. You need to have your earnest money, your option fee money, and then based on the type of loan you get, that determines how much you put down for your down payment when it comes time to closing. You got to have that down payment already. I didn't tell you that in your bank account. So if it's FHA and they say you need 3.5% down, they need to see 3.5% in your bank account. If you have to put 5% down, they need to see 5% in your bank account of your own money. You have to have that. So with new construction, they have a lot of incentives. So when I get people that's looking to purchase new construction, I generally tell them, I say, look, if you know you're going to buy new construction, if you want to get all those incentives and that very low interest rate that they're going to be giving you can't go to an outside lender or you're going to lose that 4.99 interest rate. You're going to lose that those incentives where they're going to give you $15,000 towards closing costs. Now, if you do go over to your own lender, they may still pay the title commitment sometimes. Sometimes instead of giving you $10,000 towards your closing costs, maybe they'll give you $5,000. But just know you lose a lot of the incentives they give you if you don't use their in-house lender. And then sometimes if the in-house lender can't do the loan, like I have happened with a lot of my self-employed buyers, I have a very special lender that's really, really good with my self-employed people. But if they can't do it, they'll say, we'll still honor and give you all of those incentives for new home builds. And you can still keep those incentives. But for my new self-employed people that write everything off, even though they make all the money, I have a special lender for them that has nothing to do with tax returns and 1099s and all of that good stuff. And my guy is really good about helping them to get approved. And there was something else I wanted to say about new construction because it's like a totally different animal. Oh, new construction for people that are renting, you can do what they call rent or lease buyouts. Realtors can help with those. I help with a lot of lease buyouts. So if you just sign, say, a deal for your rent. You're going to be renting for another 12 months and you come across this new construction. Oh man, it just came in my neighborhood. I really want to buy this house, but I just signed this lease. No problemo. We could do something called the lease buyout. Those are really fun. I've been doing those for over 12 years. You still can transition from your rent place into your new construction home. Very fun to do, very easy to do. So it's very possible for you to get out of that lease legally and it won't affect your credit and still move into your new property. So again, new construction, totally different animal. This is what I wanted to say. I know I talk too fast because I'm from Chicago and I keep thinking I slow down, but I haven't. The salesperson with new construction, they are so sweet. Really, really nice people. Really nice. But guess what? The sales rep does not represent you. They represent the builder. You just have to remember that. They don't represent you, they represent the builder. So repeat after me. The salesperson who was real sweet, the salesperson who was real sweet doesn't represent me, doesn't represent me. They represent the builder. They represent the builder. Very good. So when you go there, they're going to tell you all about their products, whether or not they have a design center. They're going to tell you the elevations, whether you like A, B, C, D. They're going to have the different floor plans. They're going to let you know if you can change the cabinets out, if you can increase the size, all of this beautiful, wonderful stuff. I mean, they're so sweet. They're going to offer you all kinds of snacks. And in some cases, maybe you get a glass of wine. Oh, they're just awesome. And then they're going to help you write the contract up. But the thing they're not going to do is answer any real estate questions for you because they're going to say, go and ask your real estate agent about that because we're not allowed to talk to you about that. If you don't have representation, and I've seen people go through the whole new construction thing all by themselves, and they don't have a realtor, but the salesperson is not allowed to talk to you about anything real estate related because they're going to tell you, you should have got representation or go get your own representation. And the builder does pay for the fees to have for you to have a real estate agent. You can pick any realtor you want. So it's not like, even though they're paying the fee, it's not like the salesperson picks the realtor for you. You go out and pick your own realtor and then have them represent you to the fullest. Because remember, they can help you put together that lease buyout if you need a lease buyout. I have been in situations where my people, for some reason, when they had to flip the loan, they had to bring more money to close and they were short. Well, guess who was there to save the day? The real estate agent was there to save the day. There have been a lot of different incidences where real estate agents were able to step in and help out in a way that the buyer never believed or never guessed and just thought that they weren't going to get that home. And they ended up getting that home. That's what I like when it comes together. It's a beautiful thing. So anyway, now you know, new construction, you do put down payment. And actually, depending on the loan, it's the same thing, except for I told you that it's called down payment um with the salesperson when it's new construction. And even though you're getting a loan, whether it's FHA or conventional, you still got to have that down payment money in your account. But they don't call it earnest money on the new construction side. But on the resale side, we call it earnest money option fee. On the new construction side, it's called down payment, but there's no option period. You're just doing a new construction phase. And when it comes time for you to do your first walkthrough, they'll allow you to do an inspection, get the inspection report back, give it to the GC or the general contractor that's there so that they can take care of anything that's found on the property. Another thing I want to talk about when it comes to those inspection reports, you can get something called a three-phase inspection. Most of my buyers, they get the one phase. My husband used to be a custom home builder, and we would have to get inspections at certain phases. But with the new construction, you can have them before they even start building the house. They can start that way with the plans and stuff. There's three phases to that. It's a little bit more expensive, but if you're one of those concerned people and you're okay with paying that extra money to have that done, then by all means, go ahead and pay and have that done. I've had people not get inspections done. I had a gentleman that all the bedrooms are upstairs. The contractor went on the roof to do something, kicked I guess the hot water tank, a little, I forget what you call that thing that comes through the roof. Can't think of it, it just went out of my head. But long story short, had he not had the home inspected, carbon monoxide would have seeped into all the rooms upstairs. I can't even imagine or even think about what could have happened had that inspection not been done. Another one was where the dishwasher was not plugged in, and when they turned on the dishwasher, water just started pouring out, oozing all over the place. Had another one where the hot and cold fixtures were mixed. I had another homeowner bought new construction, didn't want an inspection, was trying to save money. Upstairs in the bedrooms, the return for the AC for that room, it was not even pointing to that room, and it took 2 months before they can get out there and actually fix it. And I hate to say this, some builders are good, some builders are bad. But if you got something that's going wrong and that happens during new construction, guess what can happen? They can take their sweet time in coming out before you even close. They're your best friend. You got their cell number. They know you. Y'all singing Kumbaya. Everybody's happy. And then as soon as you close, they don't even know you. That's apart from the Bible. They don't even know you anymore. It's like, who are you? Ah, they probably even block your number. And now you're trying to, and they say, look, go to our website. You need something done or fixed, go to the website, take a number, get in line, and they'll get to you when they get to you. So whatever you need to have fixed before then, some people say, oh, don't do the inspection until it's 11 months in and then stuff start. No, 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 no. I'm from the school where you should get that inspection done before those 12 months, period. Just get it done. That's how I look at that. Get the inspection done. And whatever else, needs to be done. Get it done before you close. Because once you close, they don't know you. They don't want to know you because they're moving on to the next buyer. So that's my 2 cents on that. So let's move on. Okay, so I'm kind of going a little bit backwards, but in the beginning, we were talking about getting that pre-approval, when you fill out that application and stuff like that. I've had this happen where in the very end, when it's time to close, an IRS payment pops up. Yes. So if you owe the IRS and just because it's not showing on your credit report, kindly tell the lender, tell the loan officer that you have an IRS payment. you worked out a payment plan so that they can include it in your debt ratios, because that can come back and bite you if they have to recalculate your debt to income ratios, and now you can't afford to get the house and you just spent all this money. So just keep that in mind when you are filling out that loan application. Another thing I want to bring up too at this point has to deal with having two mortgages. Let's say you have a house right now and you want to buy a new house. There are two things that you have to take into consideration. The first thing is, do you want to keep the existing home and sell it later? You just want to move from this home to the other home, and then you fix this house up and put it on the market. Yes, you can do that. However, you have to get qualified and pre-approved for both mortgages. Now, do you want to get approved where when you submit the pre-approval, it's contingent upon you selling this house in order to buy that house because you need the proceeds from this house? Or do you get approved for both mortgages and it doesn't matter whether or not you sell this house because you can afford with your income to cover both mortgages and there's no need to pull the equity out right now? So you need to determine how that's going to work and how it's going to be. And then the third factor in this that I didn't mention because it's actually happened. If you have an FHA loan and you're trying to get another FHA loan and it's not within 100 miles or more, they're not going to let you have two FHA loans that's in close proximity. So either this one's going to have to be conventional, which means you're going to bring a little bit more money to closing. And if you can afford both mortgages, then great, because that's ended up what happened in my case. They had to flip to conventional because it was FHA. It's one of those things where I brought it up to the lender, and I guess the underwriter, they slept on it. And when they finally got to it, it's like, okay, we can't release the clear to close because we got two FHA loans here and they're 10 miles apart or 10 minutes apart. So thank God it worked out. It got fixed. But in your case, just remember what I just said. Either you get approved with both mortgages. Doesn't matter whether or not it's 10 miles or 10 minutes or 10 minutes apart or whatever. You can afford both mortgages, but they both can't be FHA, or if it's conventional and one's FHA, no problem. But if you have to sell this house, that means it's a contingency, which means that the sellers have to approve to accept your offer and allow you to sell this house. But if they get another offer in where they're ready to buy now, they can bump you out of the way and then take the person that doesn't have a contingency. They don't have another house to sell. They just want to buy the house and be gone. So yes, you'll lose your option fee money, but you won't be able to buy the house. So just keep that in mind. And we talked already about the self-employed buyers and the should you buy resale and stuff like that and fall in love with the house. Now I want to talk a little bit about the clear to close. That's the one I was telling you is the most important part of this home buying process, and it's so near and dear to my heart. Clear to close. Clear to close is when you're at the end. You're at the very end. It's time to close. It's time for the lender to send all the paperwork over to the title company. If you don't get a clear to close, guess what, people? You ain't closing. Repeat after me. What did I say? If you don't get a clear to close, you ain't closing. Yes, you heard me right. Why? Well, before the underwriter, remember that underwriter we talked about? The no-name person, the person you can't talk to, the person that can make or break your deal? The underwriter is going to check three things. They're going to verify three things before they release your clear to close. First, they're going to do a verification of employment, see if you're still gainfully employed. Second, they're going to do a soft credit check to make sure you didn't go out furniture shopping, because some people like to do that. They like to go out furniture shopping, and I'm going to have to pause this for one quick minute. Okay, so we're talking about the clear to close. Let me see, can I pull that back up? Hold on, I lost, see, my phone rang and I got all off kilter here. Let me see if I can find it. Mm, Hold on one second. Sorry, people. Here it is, docs. That's where I put it. Mhm. And my machine is moving so slow today. Why? I don't know, but here it is. Let me see if I can get it back. All righty. I got it back. Come on. There we go. Now let me shrink it a little bit. Sorry about that. Didn't want to not answer. So we're talking about the clear to close. Okay. So three things. We said verification of employment to see if you're still gainfully employed. They're going to do a soft credit pull to make sure you didn't go furniture shopping, or like I had in one case, I had a gentleman whose mom was paying for his student loans. She retired and guess what magically appeared on the credit report? A late payment for the student loans. And guess what we had to do? We had to restructure the loan. They was able to still keep the credit score because remember the pre-approval was good for 90 days and we were just on almost barely on day 60. But even though that caused their credit score to go down, they still had it locked in at the original credit score, but now it changed things a little bit. And we were able to be on the phone with the underwriter, the buyer, and the loan officer and myself. Imagine from a mortgage company. But if this with a bank, office hours are 9 to 5, and if it's with someone that's from another state, it's not going to happen. So that's why I'm saying you got to be very selective as to who you choose, preferably someone that's in the state of Texas, not being biased or anything like that, but I am. But in the state of Texas, preferably a mortgage broker. Just saying, but you can pick anybody you want. So they do verification of employment, they do soft credit pool, and they want your updated bank statements. Updated bank statements. Let me tell you the fight about that. So, updated bank statements for what? Well, they want to see that you didn't put any large deposits in your account. Or do people do that? Of course they do it. I have it, excuse me, where my buyers would say, I'm not giving them an updated bank statement. And why do they want an updated bank statement? I gave them the bank statement at the beginning of the thing. Blah, 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 blah. Yeah. I know why. What you do. I didn't do anything. Yeah, you did something. I already know what they did. I already know they made a cash deposit and they can't source it. And that's why they're fighting the underwriter and they don't want to send it in. Well, long story short, they sold some jewelry, got $8,000 in cash and dumped it into the bank account. And they know if the underwriter looks at that bank statement and see it, now they're gonna question it because they don't have a paper trail. And it's like, where did this money come from? And it just kind of messes everything up. And the same thing with people that get laid off before they close on their new home. It's like, oh, I'll get another job once I close on the house. Well, two things. Number one, when you get to the title company, there's a statement, a document you sign stating you're still, employed, you're not falsifying anything, all of that good stuff. Then number two, the lender is not going to give you a loan once they call and find out that you've been laid off. That's when they do a verification of employment before they give you the clear to close. So can you now see why the most important part of the whole process is the clear to close, not the pre-approval, not the conditional loan approval. And if I didn't explain to you what a conditional loan approval is, the pre-approval just allows you to submit the offer. The conditional loan approval comes after you have your offer accepted and you now have a full-fledged contract. Now we're waiting on the conditional loan approval. And that just means that the lender has collected all of your information. The processor is processing your paycheck stub, your W-2s, on verification of employment. They're trying to get the title commitment. They're trying to get all of this stuff in. I shouldn't say title commitment, but the basic stuff. So they're going to approve your loan with some conditions. Well, what are those conditions? Well, they're going to want a survey. They're going to want an appraisal. They're going to want a title commitment from the title companies to make sure the title of the house is clean and clear like a car title. When you get a car title, there are no liens on it. Same thing with a house. You want to make sure that the title is nice and clear, and nobody's going to come back and say, hey, you bought my house and nobody told me about it, so I still have claim to it. So they're going to make sure you got a clear title. So that's a conditional loan approval of a loan with a list of conditions. So I said all that to say, now we want to let them finish processing everything, getting all that stuff in. It's coming in hot. Now we're waiting on what is called the CTC. Well, what is CTC? Which is Charlie, Tom, Charlie, clear to close. No Charlie, Tom, Charlie, no clear to close. You ain't closing. Repeat out of me. No clear to close. No CTC, no clear to close. You have to have a CTC. You have to have it, or you ain't closing. That can mess up the whole thing. And what happens? Sometimes the underwriter, and you probably heard this, they keep asking for stuff. Why do they want this? Why do I have to keep? And now the buyer's getting upset. When in the very beginning, I always educate my buyers, say, look, your file is a difficult file, but we can get through it. Just know that if the underwriter keeps asking you for things, it's not because they want to make you mad or get you upset. It's just that they need this. So whatever they ask for, get it to them in a timely fashion. Because every time the underwriter receives a document, every time, that means that it's going to take 2 days, maybe 3 days for it to come out. They ask for something. So I say this to say, if you're supposed to close on the 30th of the month, and I tell people, don't get movers, don't take time off from work, don't take vacation time, don't do any of that until you get a clear to close. If you don't get a clear to close, don't you order anything until in your email you see a clear to close. Now we can all do the happy dance. I say the happy dance. No clear to close. You don't order any movers. You don't order anything, anyone, period. You understand? So the underwriter, every time they ask you for something, it goes into to them for them to review it. Now remember, they're not just looking at your file. They're looking at about 1,000 other files. And if it's the end of the month, oh, you can just forget it. It may be 5 days before that thing come out, because now the buyer is trying to call the underwriter or try to call the loan. Well, why is the underwriting taking so long? Then they call the poor loan officers, which they have no authority. They're at the mercy of the underwriter, just like you are. Everybody's at the mercy. The title company is calling. Well, we don't have docs yet. We don't have the buyer's file. We're trying to contact the lender and nobody's calling. They don't know anything. The loan officer, all they know is they're watching their email, praying to God that the underwriter emails them so they can tell the real estate agent and the poor buyer, give me the lender's phone number so I can call and bug the heck out of them and call them and frustrate their life. Well, guess what? Until the underwriter looks at your file and tells you whether it's a go or not a go, it's going to be crickets. So you might as well just chill, relax, and just wait the process out. The best you can do is to have the real estate agent ask for an extension just in case, because the seller, they don't have to approve an extension. That's the other thing. That's why if you weren't nice in the beginning and you falling all apart, and if the other agent is falling all apart and we don't have a clear to close and we're supposed to close on the 30th and it's the 25th and everybody's fighting and all of that can be avoided. If you just know from the very beginning that if you don't get it clear to close, you're not going to close. And what can cause you to not get a clear to close is either you didn't turn in all your documents on time, or the underwriters asked you for something else and you're taking your sweet time to get it into the underwriter. And they're going to take this sweet time for it to come back out. Yeah, they're going to be trying to rush, but if it's the end of the month, like the 25th through the 30th, they're probably looking at 1,000 files, 1,000 people trying to close on their house. So it's in your best interest to, at the very beginning, get everything in. And just know that because you don't get to clear the close right away, it's not the end of the world. What should be happening is you just need to make sure your real estate agent is able to get an extension for a couple of days, just in case you may have to bump the date to maybe the second or the third day of the next month. It's not the end of the world because you didn't take vacation time, you didn't hire movers, you didn't plan and have all these people to, you didn't plan on any of that because you were smart to know that you needed a clear to close first before you start having parties and ordering all of this stuff. So just remember, the clear to close is the most important part of this entire process. If you don't take anything else from this video, take that from this video, okay? And I always tell people that, but they think otherwise. But that's just my take on all this from the many years of doing these loans and watching people fall out and curse out the lenders and the loan officers and curse out the title company, or show up at the title company without having to clear the close and just thinking they're going to sign paperwork, or when they do get to clear the close, thinking that they're going to close the very next day or the same day. Doesn't happen, because the process is once you get the clear to close, now they send it to, the lender sends it to their closing department. Once they send it to the closing department, it can be there for 2 days because now they're communicating with the title company, trying to balance the numbers and all of that good stuff. And now, after 2 days from there, it could be a day before they actually press a button to send those documents over to the title company. Now the title company picks up the phone, they call you and say, hey, what time would you like to come in and close? We have your documents now. So just know some days can transpire between getting it clear to close. Sometimes they'll rush it. Now, if it's a mortgage company, of course, they try to do things quick, quick, quick. But if it's a bank, like I'm telling you, those big banks or those banks that's out of state, you can't just have someone go to their department and knock on the door and say, hey, we need to get this file closed quick. Is there any way you guys can close this thing? You don't have a loan officer that can do that type of thing when it's out of state or a big bank and all of this red tape and no, 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 no. But if it's a mortgage broker, yeah, those things are possible. That's why you got to be very careful of the lender that you do end up selecting. So now you know all about the clear to close and you understand that. And I believe that's pretty much it that I have. And so since you've stayed until the very end, I'm going to have 2 free downloads for you. The first one is this one. It's a book that I wrote. It's called The Calm Close. It's available on Amazon, but I'm going to give it to you digitally for free. And then there's a new construction checklist that I have that I want to give to you as well. So if you just put in the comments, no clear to close, no closing, or CTC, I'll make sure that you get those links so that you can have those 2 downloads that I want you to have. But I hope you enjoyed this video. I do want to, yeah, that's pretty much it. You enjoyed the video. Just wanted you to have that information on how to get started on your home buying process, what's important about the home buying process, what are some of the things that they really don't talk about the home buying process. And then if you just go back through this video and just look at the parts that you find the most lined up with what you're currently going through, then it can help you get through this thing a lot faster. And I promise you, this book, it actually talks about the process from the inside. What is actually going on when you get under contract? What is happening at those different terms? And it does talk about the CTC, or the clear to close, that I've been harping on and stressing on in this video. So I hope you enjoy it. And until the next video, which I'm going to be doing one, by the way, on amortizations. It's that one TikTok I was telling you about that's from bankrate.com, where if you want to play around with the numbers, is if you're putting extra money, if you get bonus money and you pay that towards principal, how much it'll knock that mortgage down and all of that good stuff. So until the next video, see you soon. Bye.